As 2024 draws to a close, uncertainty in politics and economics lingers like an unwanted party guest, showing no signs of leaving as we head into 2025, albeit in a new outfit. Donald Trump's economic agenda is no secret, a bit like a flashy Christmas jumper everyone knows too well. However, what remains as enigmatic as the contents of a mystery casserole are the specifics. What policies will actually make it to the table, when they'll be served, and how they'll settle in the economic stomach by 2025. Let's put it this way. Imagine planning a holiday dinner. You know Uncle Donald is bringing his famous economic pudding, but the recipe, its readiness, and how it'll affect the digestion of the whole household are still up in the air. Whether it's a triumph or leaves everyone queasy is, as they say, a known unknown. With the American economy slowing down, the growth rates of the US and the Eurozone are expected to converge in 2025, like two neighbors who finally decide to paint their fences the same color, but with very different motivations. The US, still grappling with the inflationary hangover of Trumponomics, will face tighter monetary policies, leaving the Federal Reserve likely to keep interest rates unchanged throughout 2025. Meanwhile, across the pond, the European Central Bank will find room to cut rates further as inflation gracefully returns to its 2% target, much like a well-mannered house guest tidying up before leaving. By 2025, then, both regions may see similar growth rates. Picture two runners finally matching pace in a marathon, but their paths to get there will look very different. The US inflation trajectory will be like a roller coaster still settling down, while Europe's will feel more like a leisurely stroll through the park. And let's not forget the unemployment forecast. It's expected to tick up in 2025. Think of it like a summer barbecue where the burgers take a bit longer to flip. The wait might leave some grumbling, but it's part of the process. So yes, the year ahead will be different from 2024. Less a rerun and more of a sequel with some unexpected twists. As 2024 inches towards its finale, we find ourselves staring at 2025 with the curiosity of a shopper eyeing the Boxing Day sales, hopeful, yet unsure of what bargains or surprises might lie ahead. The Federal Reserve's decision to trim interest rates by 25 basis points feels a bit like a slight discount at the bakery. Does it mean gold becomes the tastier treat, or is it just a nudge towards other options? Meanwhile, Bitcoin has shattered the $107,000 mark, leaving many to wonder, what's the secret sauce behind this rise? Is it the result of Donald Trump's musings about a Bitcoin strategic reserve, which sound as bold as suggesting you stash your retirement savings in a pirate chest? And then there's MicroStrategy, doubling down on Bitcoin purchases with a logic that seems to scream, why buy one cake when you can have two? So, what's an investor to do? Choosing between gold, tech stocks, and Bitcoin is akin to deciding between comfort food, a sleek new gadget, or a ticket to a virtual treasure hunt. Each offers its own allure, but the key is to weigh your appetite for stability, innovation, or high-stakes adventure. In 2025, one thing is clear. The menu of financial opportunities is as diverse and perplexing as a fusion restaurant's offerings. Choose wisely and bon appetit. Hello and welcome. Today we delve into the global market storm that's capturing headlines. Gold's tug-of-war, the dollar's defensive stance, Bitcoin's meteoric rise, and the yen's struggles. Through insights inspired by the Yi-Jing and the art of war, we'll uncover the forces shaping these markets and identify the key strategies to navigate this turbulence. Whether you're an investor, a strategist, or just market curious, this video has something for you. Don't forget to like, subscribe, and hit that notification bell so you won't miss any updates. Let's dive in. Hold on tight, everyone. In just a moment, we'll dive into the jaw-dropping shifts rocking global financial markets over the past few days. What's behind the rollercoaster ride of gold prices, the dollar's reactions, the party-like atmosphere in the US markets, and Bitcoin's astonishing breakthrough? We'll break it all down for you in the most straightforward, relatable way. Think less financial jargon, more how this affects your morning coffee and weekend plans. By the end, you'll be armed with insights to navigate this financial whirlwind and uncover those golden investment opportunities. So, don't forget to like, subscribe, and ring that little bell to stay in the loop. Right then, let's get cracking. The global financial market is much like a grand theatre, with a never-ending play full of twists and turns. On the ever-changing stage, new stories unfold daily, brimming with drama and unpredictability. Imagine it as a soap opera. One day, gold takes center stage as the hero, basking in applause. The next, Bitcoin storms in as the rebellious wildcard, stealing the spotlight. Meanwhile, the US dollar, like a seasoned actor, tries to hold its ground amidst the chaos, while tech stocks pop in and out like mischievous side characters. Just as you'd tune in to see what your favorite character does next, the financial market keeps you on the edge of your seat, never quite sure if tomorrow will bring a plot twist, a cliffhanger, or perhaps a surprise happy ending. And who are the stars of this grand production? Picture gold, the US dollar, Bitcoin, the yen, and a whole host of other currencies and commodities, each taking their turn in the spotlight. These assets put on dazzling performances daily, with their moves choreographed by economic data, geopolitical twists, and the ever-volatile mood of investors. Together, they create a spectacle of gains, losses, and nail-biting uncertainty. For investors trying to navigate this intricate stage, understanding these key players is absolutely vital. Their interactions are like a complex dance. When uncertainty sweeps in like a sudden rain at a garden party, investors often flock to safe havens like gold, giving it a moment of glittering fame as its price soars. So, whether it's Bitcoin doing a dramatic solo or the dollar and yen locked in a tense duet, the interplay between these assets never fails to keep audiences, investors, on the edge of their seats. Why is gold stuck in a tug-of-war of expectations? In the Yi-Jing, hexagram 38, Huozeku, opposition, Huozeku teaches us that divergence in perspectives creates tension, yet harmony emerges when one finds common ground. Similarly, gold prices currently sit on the rebound floor of $2,650 per ounce, resembling an athlete bouncing on a trampoline, preparing to jump higher. However, contradictory market forces are pulling gold in different directions. On one hand, the Federal Reserve's anticipated hawkish stance for 2025, higher interest rates bearish for gold, and on the other, the dollar's defensive position due to weakened US Treasury yields. Sun Tzu in The Art of War wisely noted, "He who knows when to fight and when not to fight will triumph." Gold is waiting for the perfect moment to break out, restrained by uncertainty and supported by weakness in the dollar. Imagine shopping at a department store. The shop assistant warns these limited edition shoes may get pricier next month, hawkish fed, but today's discounts, weak dollar, still hold. Do you grab them now or gamble on a better deal? That's precisely the dilemma the gold market faces. As the Federal Reserve embarks on its two-day monetary policy meeting, the market eagerly awaits the sales report from US retail data to decide whether gold will stand firm at 2,650s or retreat. On the other hand, upbeat economic news can spark a surge in risk appetite, sending stock markets into a joyous rally, as if the economy just got a standing ovation. Meanwhile, the US dollar, the steady old veteran as the world's reserve currency, quietly wields its influence over commodity prices and international trade, like the conductor of an invisible orchestra. Then there's Bitcoin, the flashy newcomer to the scene, with all the unpredictability of a daredevil tightrope walker. Its wild price swings are as thrilling as they are nerve-wracking, leaving investors both intrigued and terrified. One moment, Bitcoin is soaring to dazzling heights. The next, it's plummeting faster than your phone battery during a video call. It's a riddle wrapped in volatility, keeping everyone guessing. But here's the beauty. These numbers on the screen aren't just numbers. They are living, breathing reflections of global economic and political dynamics. Behind every price movement lies a tapestry of stories, decisions, and events that shape our world. This is the allure of the global financial markets, a never-ending drama played out on the grandest of stages. Who wouldn't want a front-row seat? Gold prices are currently stuck in a bit of a limbo, caught between the tailwind of a weaker dollar and the tug-of-war created by the market's high anxiety over Federal Reserve policies. Imagine this. You're in a department store, eyeing a pair of limited edition shoes. A salesperson leans in conspiratorially and whispers, "Thanks to the Fed's hawkish decisions, these shoes might get more expensive next month. But today, because of the weak dollar, they're still on sale." Now you're faced with a dilemma. Do you grab them now, or wait and risk paying more later? That, dear, is exactly what's happening in the gold market right now. A high-stakes shopping spree for investors. Decisions, decisions. With the Federal Reserve's policies in play, traders are a bit like shoppers in a bustling supermarket, frantically adjusting their positions on the dollar as though they're picking out ingredients for dinner. Changes in US Treasury yields? They're the equivalent of discovering that your favorite fruit has suddenly shot up in price, forcing you to rethink your entire shopping list. The market's anticipation of a Fed rate cut feels much like looking forward to a weekend party. Exciting, yet tinged with a hint of nervousness. Will the party live up to the hype, or will something go awry? Everyone is eager to see whether the Fed's decisions will season the gold market to perfection, turning it into the culinary delight investors are hoping for. Retail sales data is much like the battle report from a major sales event, dictating whether gold prices will hold their ground at $2,650 or tumble back to square one. Think of it as the aftermath of a Black Friday sale. If the numbers are strong, it's like a successful promotion, boosting confidence and keeping prices steady. But if they're weak, it's as though the sale flopped, leaving shelves empty of buyers and prices heading south. The next move for gold? Well, that depends on how this retail war pans out. Gold, often hailed as the ultimate safe haven asset, has long been cherished for its ability to preserve value during turbulent times. When inflation rears its head and chips away at the purchasing power of paper money, gold tends to shine brightest, much like a trusty umbrella during an unexpected downpour. Economic recessions, geopolitical crises, and systemic shocks all have a knack for stirring up a flight to safety, enhancing gold's appeal as a stable refuge. Central bank policies, too, play a pivotal role in shaping its trajectory. Quantitative easing, designed to boost economic growth, can inadvertently stoke inflation, turning gold into an even more attractive investment, like the last loaf of bread during a storm warning. On the flip side, rising interest rates can dampen gold's allure, as they increase the opportunity cost of holding this yieldless asset. It's a bit like choosing between a savings account with growing interest and a vintage vase that, while beautiful, offers no dividends. Gold's shine, it seems, always depends on the spotlight the economy throws on it. If we look at it from the demand side, gold demand in the third quarter of 2024 saw a 5% year-on-year increase. This was one of the main pillars supporting gold demand in the first half of 2024. The demand for gold ETFs also surged in Q3, mainly driven by Western investors. Thanks to the strong ETF demand, global investment demand in the third quarter doubled, reaching 364 tons. As a result, ETF demand naturally rose by 95 tons, marking the first positive quarter for ETF demand since Q1 2022. To put it simply, it's like a sudden rush of customers at a store after a highly anticipated sale. The Western investors, much like savvy shoppers, led the charge, and the gold ETF shelves were quickly emptied, giving the market a much-needed boost. Gold has long been a traditional hedge during periods of inflation. With Trump's economic policies likely to spark inflation, gold's appeal could rise. Import tariffs, a somewhat disruptive way to boost revenues, play a central role here. These tariffs offset 2/3 of the long-term economic benefits of Trump's tax cuts, as they invite retaliatory actions from other countries. According to US data, a new trade war could shrink GDP by 1.7%. Looking at inflation forecasts, the annual CPI is expected to drop to 2.4% in 2025, before nudging slightly higher to 2.6% in 2026. This combination of weak growth and robust inflation creates fertile ground for gold bulls, as it's like a double-edged incentive for investors. In essence, when the economy looks sluggish and prices creep upward, gold becomes the comfort food for nervous markets. Gold, our athletic trampoline enthusiast, is currently bouncing cautiously around the $2,650 mark. Why the hesitation? Because its next move depends on what shoppers are putting in their bags. In other words, retail sales data. This data is like a restaurant's footfall report for the day, a key indicator of whether market confidence will rise or take a dip. It's similar to the rental market. Imagine you're ready to raise rents, but your tenants reply, "Let's wait and see what the next economic report says." Rents might not go up after all. For gold, it's a delicate balance between staying buoyant or falling flat, all hinging on how those retail sales figures unfold. It's much like a concert, with gold standing in the middle of the stage, waiting to hear how loud the audience cheers, aka how strong the data turns out, before deciding whether to bust a move. If the crowd, or the numbers, roars, gold might leap into action, shining brighter. But if the response is lukewarm, it might just stay put, swaying gently in the spotlight, waiting for the next big cue. The Federal Reserve, as the central bank of the United States, wields enormous influence over financial markets. It's a bit like booking a high-speed train ticket. You've already secured your seat, adjusted your dollar positions, but then the conductor announces they might slow down earlier than expected. This sudden change leaves the gold train struggling to maintain its momentum. Just like on a train journey, the passengers, investors, are left wondering, should they sit tight or jump off at the next station to reassess their plans? The Federal Reserve's monetary policies, particularly its decisions on interest rates, create ripples throughout the global economy, affecting everything from borrowing costs to currency valuations. When the Fed raises rates, it can attract foreign capital seeking higher returns, strengthening the dollar and potentially putting downward pressure on gold prices. Conversely, when the Fed cuts rates or implements quantitative easing, it injects liquidity into the financial system, which could stoke inflation and make gold a more attractive option. It's as though the Fed holds the ultimate remote control, flipping between tighten and ease, with global investors hanging on every button press. The Fed's every move is scrutinized by markets worldwide, as its actions profoundly influence asset prices, economic growth, and the delicate balance of global financial stability. Whether it's steering calm waters or turbulent seas, the Fed's decisions are never short of headline-making impact. As the market fully digests the likelihood of a 25 basis point rate cut by the Federal Reserve, this comes as a blessing for gold. After all, lower rates enhance the allure of non-yielding assets like gold, making it shine even brighter in investors' eyes. Adding to this, the ever-persistent uninvited guest of geopolitical risk is giving gold an extra lift. From fresh US sanctions on North Korea and Russia to the Israel-Palestine conflict and political instability in South Korea, the global tension meter is firmly in the red. Faced with these uncertainties, investors are increasingly turning to gold, the ultimate safe haven sanctuary, as their refuge amidst the storm. Gold, it seems, thrives when the world's stage grows chaotic. The Federal Reserve right now is like a chef, with everyone expecting them to sprinkle a pinch of rate-cut salt, 25 basis points, into the soup. But then, out of the blue, someone whispers, "Next year, the flavor might turn bland. Not enough salt." It's like going to a hot pot restaurant where the server tells you they're adding a bit of chili powder to the broth today, but next time they might tone down the spice. Naturally, the big question for everyone becomes whether the soup can still deliver the kick and excitement they're craving. Similarly, for investors, the flavor of monetary policy is everything, and they're hanging on every decision that stirs the pot. While the geopolitical events of 2024 were largely driven by domestic factors, like South Korea's baffling martial law decree, next year will undoubtedly see powerful global forces ramping up political risks. For example, if Trump's trade policies take a particularly disruptive turn, we could witness a hit to global economic growth, a rise in government budget deficits worldwide, and persistent inflation. These conditions would likely drive investors to seek the safety of gold, sparking increased purchases. It's as though the world economy is a ship facing stormy seas. With the waves of trade turbulence and inflation crashing in, gold becomes the lifeboat everyone scrambles to secure. The recent US sanctions on North Korea and Russia are a bit like a neighborhood squabble. It might seem like a localized issue, but it ends up unsettling the entire community. These geopolitical tensions are propping up gold prices, much like how seeing a friend visibly anxious about something makes you instinctively feel uneasy too. Gold, in this case, becomes the reassuring cup of tea everyone reaches for when the neighborhood feels a bit too tense for comfort. It's the natural response to an environment filled with uncertainty and nerves. It's like hearing a typhoon warning. You rush to the supermarket to stock up on essentials. Gold, in this scenario, is your trusty stash of instant noodles and canned goods, safe, reliable, and there when you need it most. These geopolitical risks are like neighbors starting a loud argument while the upstairs tenants move in with a super sound system. The entire neighborhood is thrown into chaos, prompting everyone to retreat to their homes for some peace. In the financial world, this is the equivalent of investors turning to gold, a safe haven where they can weather the storm. When protests erupt in the streets and the international scene descends into chaos, investors find their only solace in the quiet, unchanging presence of their gold bars, safely tucked away in the vault. Geopolitical risks are like smoldering embers, seemingly dormant, but with the potential to flare up and send markets into sudden turmoil. In such times, gold becomes not just an investment, but a comforting symbol of stability amidst the storm. War, trade disputes, and political instability often trigger a surge in risk aversion, driving investors to seek safe havens, and with that, gold prices tend to rise. Take, for instance, the ongoing war in Ukraine, which has sent shockwaves through commodity markets, highlighting the interconnectedness of the global economy and the ripple effects of geopolitical unrest. Adding to this turbulence is the tension between the world's two largest economies, the United States and China. It's a reminder that in a globally interlinked world, uncertainty in one corner can quickly escalate, making gold the go-to safety net for investors bracing for the next wave. Casting a shadow over financial markets, trade wars, technological rivalry, and geopolitical competition all weigh on investor sentiment, influencing asset prices and shaping both risks and opportunities. It's like walking through a foggy street. The uncertainty obscures the path ahead, making every step cautious but also opening unexpected avenues for those willing to navigate the haze. For investors, these dynamics are a delicate balancing act between seizing opportunities and hedging against unforeseen pitfalls. The market seems to have found its footing, with interest rate expectations and risk-aversion sentiment both lending gold a steady hand to hold its ground. It's as if the market is balancing on a tightrope, with the safety net of cautious optimism below. For now, gold remains stable, supported by a mix of calculated expectations and a dash of global jitters. It's a delicate dance, but one that's keeping gold firmly in place. Can the Federal Reserve's potential rate cut calm market tension? Yi-Jing hexagram 15 Deshanshan modesty reminds us that balance is found through measured actions and overreaction leads to instability. The Federal Reserve's potential 25 basis point rate cut serves as a balm to the gold market, enhancing the appeal of zero-yield assets like gold. Meanwhile, geopolitics, the uninvited guest, plays its role in bolstering gold prices. Tensions from US sanctions on North Korea and Russia, the Israeli-Palestinian conflict, and Korea's political uncertainty all contribute to a heightened demand for safe havens. In The Art of War, Sun Tzu advises, "In the midst of chaos, there is also opportunity." This wisdom mirrors how gold buyers capitalize on geopolitical turmoil while gauging the Fed's moves. Think of a chaotic kitchen where diners, investors, suddenly learn that the chef, the Fed, plans to reduce the spice level, rate cuts in their dishes. Outside the kitchen, the world feels unruly, geopolitical risks. Guests opt for a bowl of comforting golden soup to steady their nerves. The market now appears to find its footing as rate expectations and risk aversion both support gold's resilience. Why is the US market thriving while others falter? The US dollar, as the world's reserve currency, holds a position of unrivaled dominance in international finance. Its supremacy grants the United States unparalleled economic and geopolitical influence, but with great power comes great responsibility. The strength of the dollar is shaped by several factors, including the health of the US economy, interest rate differentials, and global demand for dollar-denominated assets. When the US economy is strong and interest rates are relatively high, the dollar tends to appreciate. This makes imported goods cheaper for American consumers, but can harm US exports by making them less competitive abroad. Conversely, a weaker dollar can make American goods more attractive to international buyers, boosting exports. However, it also risks stoking inflation at home by making imported goods more expensive. In short, the dollar's strength is a double-edged sword, cutting both ways in its impact on the domestic and global economy. It's a balancing act that affects everyone, from consumers buying groceries to businesses trading across borders. It's like a cooking competition in a chaotic kitchen where diners, aka investors, suddenly get word that the chef, the Federal Reserve, plans to ease up on the spice, rate cuts. Meanwhile, outside the kitchen, geopolitical tensions are heating up, adding an extra layer of uncertainty. Faced with the unpredictability, everyone decides to play it safe and order a comforting bowl of golden chicken soup, gold, to steady their nerves before making any bold moves. Because after all, when the kitchen's in chaos, nothing beats the reliability of a tried-and-true classic. Yi-Jing hexagram 11, Detiantai peace. Detiantai speaks of a harmonious exchange where strength flows into weakness, creating prosperity. The US market embodies this dynamic, with the Standard & Poor's Global Services PMI soaring to 58.5, far above expectations of 55.8. This unexpected vitality reflects the rekindling of America's animal spirits, akin to an electrifying concert that mesmerizes its audience. Technology stocks, led by AI innovation and chip manufacturing, are the stars of this show. The Nasdaq's record-breaking highs resemble a dazzling financial laser light display. At the same time, Bitcoin, the internet superstar, steals the spotlight by surging past the $100,000 milestone. Sun Tzu stated, "The skillful fighter puts himself beyond the possibility of defeat." The US economy exemplifies this with its strategic dominance, attracting capital from weaker markets in Europe and Asia. Picture two night markets. The American market is alive with fireworks, AI booths, and Tesla car exhibitions, bustling with energy. Meanwhile, the Asian and European markets struggle with lackluster stalls, their proprietors deep in thought about ways to attract customers. This unexpected burst of energy has everyone buzzing, much like the thrill of your favorite DJ making a surprise appearance at a party. The vibe instantly shifts, the crowd goes wild, and suddenly the night feels unforgettable. Similarly, the US market's unanticipated strength has injected a jolt of excitement, leaving investors dancing to the upbeat rhythm of economic expansion. The Nasdaq hitting new highs feels like lie. Tech companies showing off their latest dance moves at the party, each vying to be the center of attention. Tech stocks are stealing the spotlight, with artificial intelligence and chip technologies leading the charge. The Nasdaq's relentless climb to record-breaking highs is like a spectacular laser light show in the modern financial arena, dazzling, dynamic, and impossible to ignore. What fuels Bitcoin's meteoric rise while the yen flounders? As market excitement reaches fever pitch, Bitcoin, the internet superstar, refuses to be outdone, smashing through the $105,000 barrier with dramatic flair. It's as if the digital icon has joined the party with a headline act, ensuring all eyes are on its meteoric rise. The Nasdaq hitting new highs feels like tech companies showing off their latest dance moves at the party, each vying to be the center of attention. Tech stocks are stealing the spotlight, with artificial intelligence and chip technologies leading the charge. The Nasdaq's relentless climb to record-breaking highs is like a spectacular laser light show in the modern financial arena, dazzling, dynamic, and impossible to ignore. As market excitement reaches fever pitch, Bitcoin, the internet superstar, refuses to be outdone, smashing through the $105,000 barrier with dramatic flair. It's as if the digital icon has joined the party with a headline act, ensuring all eyes are on its meteoric rise. Bitcoin is poised to become the new elite guard of economic turbulence. Right now, it's like a dusty old bottle of millennial wine sitting quietly on the financial market's shelf. Then along comes Trump, declaring, "Add this to the national reserves." And suddenly, chaos ensues as everyone scrambles to grab a bottle. Bitcoin has become the financial world's limited edition black truffle. Once a celebrity proclaims its greatness, the price shoots through the roof, and the frenzy begins. If you've invested in Bitcoin, you're in the middle of a full-blown Vegas carnival, with prices skyrocketing like fireworks, lighting up the night sky of your investment portfolio. It's exhilarating, unpredictable, and undoubtedly spectacular. Bitcoin, as the pioneering cryptocurrency, has swept across the globe, captivating investors with its soaring prices and stomach-churning volatility. As a decentralized digital currency, it operates independently of central banks and governments, making it especially appealing to those searching for an alternative to traditional financial systems. Its limited supply, capped at 21 million coins, fuels speculative activity, propelling its price to dizzying heights. It's a bit like a rare collectible item, coveted for its scarcity, with bidders driving up the value in a frenzy. However, Bitcoin's roller coaster-like volatility, lack of regulation, and susceptibility to hacking and scams make it a quintessential high-risk, high-reward investment. It's akin to choosing between a thrilling yet precarious zipline ride and a stroll through a safe, predictable park. For those willing to take the plunge, it's an adventure, but certainly not one for the faint-hearted. However, its future remains uncertain. Some predict Bitcoin will eventually fade into obscurity, while others hail it as the future of finance. The birth of Bitcoin signaled the dawn of a new financial era, challenging traditional currency and banking systems. Its decentralized nature allows transactions to occur without intermediaries, making it hugely appealing to those seeking to bypass conventional financial institutions. It's like a DIY recipe that skips the need for a chef. Straightforward, flexible, and empowering for those who prefer to take control. Yet, whether this new recipe will become a classic or be shelved remains a question that keeps investors and skeptics equally captivated. However, this brings with it new challenges and risks. Bitcoin's price volatility makes it an unreliable store of value, while its anonymity has led to its use as a breeding ground for illicit activities. Even so, as more businesses and individuals embrace Bitcoin as a payment method, its influence and significance continue to grow. It's akin to a wild horse, unpredictable and hard to tame, but undeniably powerful when harnessed effectively. Whether Bitcoin can overcome these hurdles and integrate itself into the mainstream financial system remains to be seen. For now, it's a thrilling, albeit uncertain journey, one that has the world watching closely. What fuels Bitcoin's meteoric rise while the yen flounders? In this global financial spectacle, Bitcoin has taken center stage as the grand finale star. A single remark from US President-elect Donald Trump: "We should consider establishing a strategic Bitcoin reserve, storing it like oil," sent Bitcoin prices soaring to an all-time high of $107,793. Adding fuel to the excitement, MicroStrategy's bold move to increase its Bitcoin holdings has further bolstered market confidence. It's as though Bitcoin, once a niche performer, has now become the headliner of the show, commanding the spotlight and captivating an audience eager to see what comes next. Bitcoin smashing through the $105,000 mark is like that one friend at a party suddenly announcing they've won the lottery. Everyone rushes over to congratulate them, eyes wide with excitement. Trump's bullish stance on cryptocurrencies is the equivalent of adding even more fuel to the party buzz. It's like he's walked into the room with a megaphone, making the celebration louder and the chatter livelier, ensuring Bitcoin stays the talk of the town. Since 2010, the price of gold and the US dollar index have tended to move in opposite directions, a relationship that's entirely logical. Gold is priced in dollars, so when the dollar weakens, you need more dollars to buy an ounce of gold. Looking ahead to 2025, composite forex forecasts suggest that the dollar will depreciate against the euro after the first quarter, while the pound is expected to climb to $1.30 by 2026. This anticipated decline in the dollar's strength is likely to give gold prices a boost in 2025, much like a tailwind helping a kite soar higher. For gold investors, this interplay between currencies and commodities offers a potentially golden opportunity. However, on the other side, the yen has become the market's sitting duck. With the Bank of Japan maintaining its cautious stance and refraining from signaling any interest rate hikes, the yen is left awkwardly sitting on the sidelines, watching the dollar show off its fancy footwork on the financial field. It's as if the yen brought its boots to the match, but never got the call to play, leaving it to quietly observe the action while the dollar steals the spotlight. The yen is certainly facing headwinds this time around. It's like a student who hasn't studied enough for the exam. When the teacher asks, "Are you ready?" they can only smile nervously and reply, almost. Meanwhile, it's as if hotel prices in Japan remain stubbornly low, leaving landlords wringing their hands while tourists flock to book luxury resorts in the US, dollar-denominated assets. Over in the forex airport terminal, the yen's flight is stuck on the runway, waiting for clearance, while other currencies' planes are already soaring at cruising altitude. It's a grounded, awkward moment in a sky filled with movers and shakers. The yen was once the superhero of the economy, but recently it seems to have lost its superpowers. While there's speculation that the yen might stage a comeback against the dollar, Japan's struggling economy, deflationary pressures, and towering government debt make the yen feel like it's carrying a mountain on its back. The Bank of Japan's ultra-loose monetary policy might be giving Japanese exports a competitive edge, but it's also left Japan's savvy shoppers feeling the pinch, as their wallets have slimmed down considerably. It's as if the yen, once flying high with a cape, is now trudging uphill with a heavy load, trying to regain its former glory. It's a tale of two athletes. The dollar, sprinting across the track in the latest pair of AI running shoes, while the yen lags behind, still wearing an outdated model and barely warmed up. The yen's fate is closely tied to the global economic outlook and Japan's ability to tackle its structural challenges. A global economic slowdown or a resurgence of risk aversion could boost the yen's appeal as a safe haven, like an underdog suddenly being cheered on in the middle of the race. On the other hand, successful economic reforms in Japan could strengthen its long-term prospects, giving the yen the energy it needs to finally lace up those new shoes and get back in the game. Yi-Jing hexagram 35, Yi-Jing progress. Yi-Jing teaches that breakthroughs arise when bold steps are met with favorable timing. Bitcoin's surge to a record $107,793 reflects this principle. A single remark by US President-elect Donald Trump, suggesting a strategic Bitcoin reserve akin to America's oil stockpile, ignited the rally. Institutional players like MicroStrategy bolstered confidence by increasing their Bitcoin holdings, further amplifying the momentum. Navigating the complexities of financial markets requires careful planning, diversification, and a long-term perspective. Before making any investment decisions, investors should thoughtfully assess their risk tolerance, investment goals, and time horizon. Diversifying across different asset classes, such as stocks, bonds, gold, and real estate, can help reduce risk while potentially enhancing returns. Staying informed about global economic trends, geopolitical developments, and central bank policies is crucial for making well-informed investment choices. Additionally, seeking advice from qualified financial professionals can provide valuable insights and guidance, helping investors chart a course through the ever-changing landscape of financial markets with greater confidence. As 2024 fades into history, the uncertain landscape of 2025 beckons, a time that calls for a delicate balancing act in investment strategy, much like the wisdom found in the Yi-Jing hexagram, Zhe Lake over fire, which advises us to seek equilibrium while navigating change. In today's unpredictable world, successful investing requires this same subtle balance. On one hand, investors must shield their wealth from the erosive forces of inflation, economic turmoil, and geopolitical risks. On the other hand, they must seize opportunities for growth and stability. Gold, with its centuries-long reputation as a store of value, plays a pivotal role in a diversified portfolio. It serves as both a shield and a stabilizer, an anchor for uncertain times and a beacon for those charting a course through the intricate labyrinth of financial markets. Balancing preservation with opportunity is the key to thriving in the maze of 2025. On the other hand, investors must also seek growth opportunities to build wealth over the long term. Carefully analyzing investment options, understanding the risks involved, and maintaining discipline in the face of market volatility are essential ingredients for financial success. To stay ahead in a competitive environment, investors need to continuously learn and adapt to new market trends and emerging technologies. Remember, investing is a marathon, not a sprint. Patience, diversification, and a long-term perspective are key to navigating the ever-changing financial landscape. By diversifying their portfolios, investors can reduce risk while increasing their chances of achieving strong returns. It's about striking a balance between cautious protection and bold ambition, ensuring that the journey through the financial maze is both secure and rewarding. Additionally, regularly reviewing and adjusting one's investment portfolio is essential to ensure it remains aligned with personal financial goals and risk tolerance. This ongoing process of fine-tuning helps investors stay on course, especially as life circumstances and market conditions evolve. Seeking guidance from professional financial advisors during this journey can provide invaluable insights, enabling more informed and strategic decision-making. Successful investing is not just about accumulating wealth. It is a means to achieving financial freedom and fulfilling life goals. It's about using money as a tool to live the life you envision, with a sense of security and purpose. Quantitative change is the necessary precursor to qualitative change, while qualitative change is the inevitable result of quantitative change. Quantitative change represents gradual shifts, an increase or decrease in numbers, while qualitative change is a leap from one state of being to another. The purpose of predicting the future is to shape it. Every effort we make today to instigate change will ultimately become an integral part of the future itself. It's the accumulation of small steps that paves the way for great transformations. In this sense, the future isn't something we wait for. It's something we actively create. The current global market landscape is a complex one, where favorable and unfavorable factors coexist, and opportunities walk hand in hand with risks. Every region on Earth, shaped by its unique latitude, longitude, and resources, presents distinct opportunities and challenges. With the power of artificial intelligence, including neural network computations, we can synthesize real-time insights based on regional characteristics and national economic data. By watching our weekly videos, you can stay informed with a wealth of knowledge, investing minimal time while finding multiple ways to enhance your quality of life. In these turbulent financial times, adaptability and proactive risk management are absolutely vital for survival. Regardless of your level of investment experience, it's crucial to catch our video premieres to make more informed decisions. Remember, knowledge isn't just power, it's a tool to increase your value and open up new opportunities. If there's a topic you'd like us to cover, please feel free to leave a comment. We deeply appreciate your support, and as this episode concludes, I want to extend my heartfelt thanks to all of you for tuning in. If you found today's video helpful, don't forget to give it a like. It's the easiest way to find it again later when you need a refresher. Your attention and engagement mean the world to us. Thank you. Thank you.